Hey, Hannah. Welcome, welcome. Aaron's on, Mauricio's on. What's up, guys? Tyson's on. How you doing, Tyson? Long time no talk.
Yep, long time no talk.
Don's here. What's up, Don? I just saw a text message from you saying you wouldn't be able to make it today, so I'm glad you're here. All right, well, welcome back. Second week of the year, right? So far, so good. Hopefully for everyone. Got some fun stuff we're going to be sharing today. I've been working on that 13-unit complex, that conversion from a gym to a 13-unit apartment building. So we're going to be talking a little bit about some of my experiences today. I think a lot of very educational stuff. Might even turn into a guest speaker that we can have on the call here. Eugene's back. What's up, Eugene? How are you? Good to see you, my friend. All right, Uriel's jumping on. Hi, Uriel. All right, Tyson, I need to make you a co-host here.
Perfect.
It only allows me to make you the host. Can you make me a co-host? I just made you the host here. All right, I'm excited to see a lot of your beautiful faces coming on here. If you can, turn on your camera. Let's make this a discussion today. We've got some awesome stuff we're going to be going over, a little bit of a training, and then we're going to be opening it up to you guys. So think about, before we get into the training, be thinking about any of the projects you're working on, whether, regardless of what stage you're in, if you're having problems at any point, if you're hitting obstacles, if you're hitting walls, let's talk about it. And then let's work through it together as a team. So these always go a lot better as discussions. So turn on your video, come off of mute. Let's have a discussion. All right, and as usual, we have people trickle in throughout the call. So I think we'll go ahead and get started. It's 2 minutes past the hour here. So welcome everybody. Hopefully everybody had a fantastic New Year. Some of you I haven't seen since last year, so welcome back. I've been working on a few really cool things. We over the course of December to January, we launched a new web series called Flippin' Sexy Real Estate. We're going to talk a little bit about that today towards the end of the call. We've launched 2 episodes so far. They've been doing awesome, and we're launching our 3rd episode here in about a week. It's our ski house that we did in Cottonwood Heights, Utah. So you guys are going to be able to see that and see the process that we went on, the adventure that we went through. For those of you who are joining us, I'm seeing some, Jeff Larson's here. What's up, Jeff? Long time no see. Good to see you, my friend. You're going to be able to see some of that adventure that we went on, the ski house, and there's some personal stuff in there, some lifestyle stuff you guys will get to enjoy. So a lot of really good stuff coming your way. Make sure, if you haven't had a chance to go onto YouTube and subscribe yet, make sure you go just into the YouTube search browser, type in Flippin' Sexy Real Estate, and hit that subscribe button. You'll be notified whenever we drop any of our new episodes, because there's a lot of educational stuff in there. These episodes are designed to be entertaining, but they're also designed to be educational. And one of the things that I can do through that medium that I can't do maybe, on the Ask Mitch Anything calls that we do on a weekly basis or in the education, is I can take you in and show you actual steps and problems that we're facing and the solutions that we come up with for those problems. So, some of it's dramatized. We can't always catch everything on camera, so we've got to kind of reenact some of the stuff. But I try to make it as real as possible so that you guys can see the solutions that we come up with, Band-Aids that we put on things just so we can get projects done. So it's a great series. Check it out. Make sure you subscribe. Make sure you like the videos. That helps the YouTube algorithm and is only going to allow us to create more of that content. So, man, we've got people coming in like crazy. That's awesome. 14 participants at this point. So I had an experience today. For those of you who don't know, I have been working on a project, and it's taking me a really long time in due diligence. We're in our 4th month of due diligence on this project. This is an apartment building. Well, it will be an apartment building in Ogden, Utah. Now, this is a structure that was built in 1902. It was originally built as a school by the city of Ogden. And it was, at the time, it was everything. It was the school, right? It was the elementary school. It was the middle school. It was the high school, 18,000 square feet, but in Ogden in 1902, there weren't a ton of kids. So it worked. In the 20s, maybe the 30s, they built another school that housed the middle school and the high school kids. That became an elementary school. And then in the 60s, the city sold it off to a private individual named Audrey that turned it into a women's fitness center. She ran it as a women's fitness center for about 25 years, up until about 2002, 2003, when she passed away. And the building has been vacant ever since. Now, our goal, this is a building that is prime real estate. In Utah, you hear location, right? We've got houses that we've been working on. I mean, Tyson, you're in on a few of them. Wade, you've been in on a few deals. You know that location dictates our after repair value, which also dictates what we can buy it for. And it can differ in the tune of hundreds of thousands of dollars just based on, a mile difference or a 2-mile difference, one side of the freeway versus the other side of the freeway, right? So this particular building, this historic building, is right across from an LDS temple in Ogden. Now in Utah, obviously headquarters for the LDS Church, that is a big deal. When we're talking location, if you can be in the neighborhood of one of the LDS temples, that is one of the most desirable areas in Utah. And so this one is just right across the street. It's literally across the street. It's an abandoned building. Obviously, Ogden City doesn't want it like that. Nobody wants it like that in this prime real estate area. And so it's actually been a really cool experience working with the city, because previously working with cities on projects has been a nightmare, right? There are bureaucracies. There's a lot of red tape. There's a lot of hoops you got to jump through. Now, granted, they're there to help protect the people that will be moving into the buildings and preserve the integrity of the city. And I understand all of that, but that doesn't change the fact that it's really hard, right? As a real estate investor, working with the city and the governments is one of the hardest things you'll do. But Ogden City has been awesome with this. I mean, as we've been working on permits and zoning and different things, they've expressed nothing but support with what we're trying to do. We're going to take this 18,000 square foot building and we're going to turn it into a 13-unit apartment complex. These are going to be high-end luxury apartments, probably the most luxury apartments that you can get in Ogden City. So we're talking rents in the tune of $2,000 to $3,000 a month. So it's been a fun project. Now, I met with Cache Valley Bank at the property today, and we had a pretty awesome experience going through some of the things that we're planning on doing, and some of the ways that they can participate in funding this project. They also brought some really cool insights to the table, and that's what's inspired today's topic and today's training. So it's going to be a short training today, and then we're going to open it up. We're going to talk about whatever you guys want to talk about. That's why this call is called Ask Mitch Anything. We get to talk about what you guys are facing in real estate. So the key to real estate, and I had one of my students with me. Some of you know him, Ken Cordova. Ken's been investing in real estate for 25 years. He linked up with me and we've been out doing some more advanced stuff, right? Because he has a little more experience than most in real estate. He has more experience than I do in real estate. But he wants to get to that next level. And so I said, hey, come follow me and we'll do, we'll work together on both of us getting to the next level. So we've been working on this project together. The key to real estate, on the drive home, Ken and I were talking about this. The key to real estate is, we talk about all these things, getting out and finding properties and getting out and finding money and getting out and finding these things. Real estate will be a lot of work. It will be a lot of work for you if you don't focus on this thing first. And this thing is relationships. Relationships can make real estate an easy game. We took the head underwriter and the head loan officer for Cash Valley Bank to lunch today before we went over the property, and we just shot the bull. We got to know each other. We talked about a lot of the deals that we'd all been a part of and that we've worked on in the past. We talked about politics. We talked about what Ogden City's doing right now and where they're going and where they've come from, and the transformation that the city's going through. And it was really cool because it established a relationship that now is going to be something that we can call on for years to come. In fact, some of the nuggets, after we got done with lunch, we went over to the property, we were walking through, and he shared some things with me that he probably wouldn't have shared had we not taken the time to build that relationship. And this would have been stuff that maybe would have taken me years to figure out, or even doing it wrong a couple of times to figure out had I not built this relationship. One of the things that he shared with me is that there is a default to when properties get placed on historical registries. So for example, the state of Utah has a 100-year default. If there's a building that's 100 years old, it's automatically on the historic registry. It doesn't have to be specifically added. It's automatically there. The federal government also has an historic registry. Other states, I'm sure every state in the country has an historical registry. There are some benefits and there are also some drawbacks to working on historic buildings, right? The drawbacks are you've got a lot more rules that you have to follow. There's certain things that you can do and certain things that you can't do, particularly to the outside of those buildings, those houses or the edifices, whatever style of building it is, and some restrictions on the inside of what you can and can't do. Now, this building, we're planning on taking it into the 21st century with a bang, right? We're going to be putting solar on it. We're getting rid of any need for natural gas. Really what we're trying to do is create an environmental, a completely green building. So everything's going to be run off of solar. Everything's going to be run off of the solar power there. Now, this is something I've been wanting to do in residential real estate for years, but because of certain laws and because of costs, it's been prohibitive. So I haven't been able to do it, but in multifamily, it makes sense. We're going to be putting solar on this building. We're going to be charging extra rent. Now, we're not going to be jacking up the rent prices, let's say from $1,200 to $1,500. What we're going to be doing is charging the $1,200 a month in rent on average in this building. And then we're going to be charging an extra $100 or $150 based on usage for power. So we become the power company. By making the investment upfront in the solar, we can now create a profit center for ourselves in this multifamily project where we're also getting income. Now, not only is it awesome because of cash flow, but that also affects what's called our NOI. NOI stands for net operating income. And that's basically any income that you have coming in from any source, whether that's vending machines or coin operated laundries or solar, if you're the power company in this example, anything that you have going on in that, rents, all of those things, any income you have coming in, minus any expenses, not including debt service. Okay, so NOI, this is important. You're going to want to remember this, especially if you plan on getting into multifamily. NOI is what your value is set off of on commercial multifamily properties. And it's based on your income minus any verifiable expenses, not including debt service. Now, anybody want to venture a guess? When I talk debt service, what am I talking about? Anyone?
Mortgage. It's Rosa.
Windows.
Hi.
Bingo. There it is. Hi, Rosa. Yeah, and you nailed it, Rosa. It's the mortgage. So the reason that we don't count mortgage in the NOI is because some people might come and buy this property cash, right? If we've got a valuation that's based on our NOI, we don't want to affect that by assuming that they're going to get a mortgage. They may bring in cash partners. They may, have their own financing. Somebody may only finance 25% of it. Somebody might finance 100% of it. So they have to do their own math to make sure that they're going to be able to cover their debt service. But the expenses are going to stay the same. The utilities should stay the same. The property taxes should stay the same, regardless of who the owner is. The garbage, the disposal service, that expense is going to stay the same, regardless of who the property owner is. So That's how we calculate NOI. And then we take that and we times it by a cap rate, and that gives us our value. Now, in Utah, I think a 6% cap rate right now for multifamily is a fairly conservative cap rate on A plus properties like this one's going to be. At a 6 cap, we are at $3 million valuation. Now, our acquisition is $900,000 on this property. Our build out, so we've got to convert this thing into a 13-unit complex, a luxury complex to boot. So that's going to cost us about $1.2 million. We are $2 million into this thing at a 6 cap, which again, for the quality of the property is fairly conservative. We're at $3 million. Now, I've had agents walk this thing. I've had, today we had the executives from the Cash Valley Bank walk this thing. And, I've heard everybody say you're crazy for valuing it at a 6 cap. You should be at a 5.5 or a 5 cap. Now, when you're selling a property, you want a lower cap rate, right? So a 5 is going to put me at like 3.4 million, right? Whereas 6 is going to put me at 3 million. So if you're the owner and you're selling it, you want a lower cap. If you're buying it, you want a higher cap, because that means you're buying it for lower, right? So, today I was told, and I've been told in the past 5.5. Today I was told, hey, you should be valuing this at a 5 cap. So we're walking into anywhere from $800,000 to $1.2 million worth of profit on this thing. Now, my initial plan with this property was to turn around and sell it, right? To fix and flip it. Now, fixing and flipping a multifamily, it's exactly like flipping a single family residence, with one exception. At the end of flipping a multifamily project, you want to tenant it out. So if we're going to go in and we're going to restore every unit, or in this case, we're going to build every unit, right? We're going to build out kitchens and bedrooms and bathrooms into each of these classrooms. We at the end of it, we're not just going to turn it and sell it vacant, because our income isn't there. And like I just said, our valuation is based on our net operating income, right? So if we turn around and tenant it after we finish the project, if we put tenants in there and they start paying rent and we fully tenant this thing, it's going to be worth a lot more to the next investor, the next owner, than if we just sold it vacant, right? So now we've got income coming in. We can turn around, we can sell it if it's fully tenanted, maybe even at a 5 cap for 3.4 million. Now, few things that I learned today that have changed our trajectory on this project. It's made me more excited about it. First off, this is in the Ogden Opportunity Zone. So Ogden gives us a break, a tax credit for 5 years. We don't have to pay property taxes on this project, as long as we hold it for 5 years. If we turn around and sell it in a year and a half, we don't get that break, right? But if we hold it for 5 years, we don't have to pay property taxes for those 5 years. So there's a huge benefit, right? As long as they approve the project and it meets their specifications. Now, the other thing is, this is potentially on the federal historical registry. It's on the state historical registry for sure, because it's over 100 years old. And it's on the local historical registry as well. There are income tax credits that come along with that as well. So, for example, the income tax credits from the state is 20%. So whatever the value of the property is when we sell it at the end, let's say that's 5 years from now. Again, we have to hold it for 5 years. If we sell it in 5 years, whatever we sell it for, let's say $4 or $5 million, we get a 20% tax credit of that. So if we sell it for $5 million, we get a $1 million tax credit, income tax credit. That's huge. That means, and a credit is different than a deduction, right? A credit means that's as if I paid $1 million worth of taxes, right? Credits are better than deductions. So that's pretty awesome, right? The next thing is that if it's on the federal registry, which I'm still doing research on, if it's on the federal registry and we hold it for 10 years, then we get to take advantage of I was doing research on this today, and I'm trying to recall the exact details so I can share them with you. We get to take advantage of what's called a basis adjustment. So any money that we put into the property above and beyond the original acquisition, which is $900,000. So let's say we put $4 or $5 million into the property, we sell it 10 years later for 6 or 7 million. We only have to pay tax on that original 900,000. because we're restoring a federal historical landmark. So there are a lot of advantages to working in, on historical properties. Granted, there's some drawbacks, right? We've got a lot more rules we have to follow, but there's some huge advantages there. So now I would not have found out about any of this stuff if it weren't for the relationships that I have. And my introduction to this individual that works at one of the executives there at Cache Valley Bank, I wouldn't have met him if it weren't for relationships. Real estate is done most effectively through relationships. You can work smarter by leveraging relationships, right? So, for those of you who are still looking to get out and kind of looking to finance that first deal, or maybe you're having a hard time finding properties. You might be one lunch meeting away from finding a property. Take a wholesaler to lunch, right? Get to know him. Let him get to know you. Laugh together. Talk politics together. Whatever the case might be. Talk sports or cars or guns or whatever you're into. Talk about that together. Find out what you have in common. Become friends with these people, and it's the relationships that are going to bring you the success in real estate. They'll bring you deals. They'll bring you money. They'll bring you tax incentives, right? They'll bring you all sorts of stuff that you wouldn't have had access to on your own. This is a really difficult business if you're going to do it by yourself in the dark. But once you start surrounding yourself with the right people and making friends with the right people, that's when your business is really going to take off. So that's what I wanted to share with you today, just my personal experience of how real estate has become so much more easy for me as I focused more on the people and less on the bricks and mortar, right? More on the people and less on the step-by-step, the A to Z stuff. It's a relationship business. And the faster that you guys can break into that, the faster you're going to be successful with it, regardless of what level you're at. So with that said, I just wanted to do that small training on relationships today. Let's get back to the purpose of the call today. I want this is about you guys. It's not about my experiences, right? I share those with you for educational purposes, but really this is about what you guys want to learn and what you guys are dealing with, and helping to provide solutions to those problems, whether it's through the relationships of the other people here on the call, or simply just experiences that I have that I can help you with. So let's talk about it. What are you guys dealing with? What are you out doing right now? What are you working on? And let's get out and answer these questions. So feel free to come off mute, ask your questions, and let's go from there.
I always dominate all your time, but I have a question.
Sheri, how are you, Sheri?
I'm good. How are you?
Good.
Okay, so I learned something new. I found a out-of-state property through a partner that I've been trying to do some deals with.
Yeah.
And we had it under contract. $21,000 is what we were going to be able to pay for it, and sell it for $159,000. And then when we went back to the lender who said they would fund it, now we're running into a problem because doing a rehab on it and getting the funding for that is now an issue because we got it so cheap.
Okay, so you're buying this property for $21,000. Your ARV is $159,000, correct?
Right.
Where's this property at?
Mississippi.
Okay, that makes more sense. Because I know you live in Utah, so I was like,
Yes, I do.
buy houses for
You're like,
$21,000.
no, you
This
can't
is Taylor.
a property for that in Utah for sure.
Yeah. Okay, so you say you're having an issue because the whoever's funding it is saying, hey, we're not gonna give you a loan on this because you're buying it for so cheap. That's crazy. I've never heard that before. Are you getting traditional financing?
Actually, somebody you know.
Okay.
You reminded me too. So.
Yeah, Mitch, can
Go ahead.
I've also just had the same issue on two properties where the purchase and after repair value at that time was both under 100,000. And so I applied for mortgages around about 62, 65,000. And one of the problems you start running into is that these regular mortgage companies have these ratios. And with that small amount of debt that you're applying for, the closing costs become an issue. And I actually closed last week, and I mean, apparently the lawyer was running around with the bank, and then he sort of looked, I'll just waive my entire fee just to get into compliance so that we can close. And then I paid him separately. So,
that-
I mean, I
that
don't know,
might be
that's
what you're
just unique
dealing
to
with.
Connecticut, but yes.
You know, Sheri, with
Thousands.
that,
Yeah.
and that's a good point, Eugene, is it,
Yeah,
I think at a certain point, it becomes not worth it, right?
exactly.
Because hard money, 12% a year on $21,000, that's pennies, right? When they could go, if it's any of the people I'm thinking of, they're probably used to doing $200,000, $300,000, $400,000 transactions. And so $21,000, they're like, look, it's not even worth my time to write this thing up. And that's probably what you're facing. So one of the things that we might look at, Sheri, is privately funding it. This might be an opportunity, especially with the margin you have. What are your projected rehab costs?
I have the quote back from the guy. I haven't looked at it again because I made him readjust it. Initially, he was trying to say something like 50,000. I was like, no, we're not doing that. So I'm hoping it came back closer to 30, but I'll have to look at it and I can forward it to you. I've got it in my email. I haven't looked at it today.
Okay, let's just assume 30, just for the sake of the conversation. Yeah. So we're $51,000 in.
Yeah.
We're gonna have at 159, we're gonna have some holding costs. Now, this might be one. I know I talk a lot about the debt equity blend. This might be one because of how. I mean, you could have one equity partner come in, split it with them 50-50, and they could fund this whole project at 51 grand, right? So I'm going to put holding costs, and that's probably what I would do if I were doing this project myself. So I'm going to put holding costs at 0. Let's talk agent and closing fees. I usually run to just, agents are usually 6%. I usually run about 1.5% for closing the transaction with a title company. So if we're selling this for 159 times 0.07, we are 11,000. Let's call it 11 grand. We're 11,000 in on closing costs.
Mm-hmm.
Your holding costs, if you structure it as equity or nothing, you just have to split the profit on the back end, right? Yeah. So we are $72,000 in. So if we're 159 minus 72, we're $87,000 in profit. That's a great deal, especially for the low amount of
it is.
Yeah,
I know. I was all excited, and then I was getting rejected.
I want in. I'll be your equity partner. That's awesome.
Okay, awesome.
And then we take 87,000. We divide that by 2. Yeah, that's 43,000 a piece. I mean, who's gonna say no to that? 43,000 a piece. But that's the way I would fund this one. I wouldn't work with hard money. It's not going to be worth it to them, right? And that sounds like that's the heartburn you're getting is, look, I don't want to write a $21,000.
Probably. Even though I've been talking to him and I said, I'm just trying to get that first deal funded so I can get money to do additional deals. And that wasn't even enough of a bait for him to be like, yeah, let's do it.
Was this Matt?
No. It was Scott. Your Arizona guy.
Oh, okay. Yeah. Okay.
So yeah, and I've even talked to an agent out there who lives in that city, asked her about the market. She said it's great. A rehab would sell quickly. It's on a big lot, so it's probably a good property to do.
Yeah, I'm definitely interested in taking a look at this deal. And you know what? There's probably other people on this call that are interested in looking at this deal at a $51,000 buy-in. So, to make, I'd put $51,000 in to make $43,000 any day. Right? Okay. I'd stand at that machine all day long. That's awesome. Very cool. Is that helpful, Sheri? Does that give you some direction on what you need to be looking at here?
Yeah.
Okay. So I think equity is the way to go on that. 100% equity. So let's have a conversation.
Okay.
Because I'm definitely interested in being your equity partner.
Awesome.
Okay. Good question. Awesome. That sounds like a great deal, right? Isn't that frustrating? Like, I've got this amazing deal that I'm going to make $87,000 on, but nobody wants to fund it.
I know. And it's so cute. It's just a little brick rambler and it just needs a few little things here and there and a roof. But, so that's why the rehab, we're like, yeah, just do a total rehab. Let's make this thing look really nice. Yep. And then the lender's like, yeah, well, and you're going, oh my gosh.
Yeah. No, I hear
Okay. Cool.
you. Thank you for the question, Sheri.
Yep.
All right. I love it. I love it. We're out moving and shaking and making deals happen. Very cool. All right, guys, what else you got for me? Let's bring the next question to the table. Feel free just to come off of mute and let's hit the next question. See, Eugene's off mute. Do you have a question, Eugene?
No, more so just a feedback. So
Okay.
I'm sort of between things. I closed last week. We purchased another long-term rental, but I actually reached out to Cody back. Was it this week or late last week? And so I'm interested to actually set up a. Well, I spoke to him, and it looks like basically is going to be set up a solo 401 trust, so that I can start utilizing that cash into some rental properties. So, but he's unfortunately not come back to me, so I sent him another reminder today. And then also speaking about relationships, a guy in my local town posted something on Facebook. He was looking to buy some properties because there's just nothing available here with all these New Yorkers buying. And so I reached out, and we had a great conversation. And as you said, we're setting the time up to have some coffee, and he's definitely interested in possibly doing some JVs, being an equity partner, which is pretty awesome.
Very cool. Yeah, that's awesome. Making things happen. I love it.
Hopefully.
I love it. I know there's been several properties that you've brought out on this call and that we've been, discussing. So I'm glad to see that things are happening for you.
Good. Thanks.
Very cool.
Hey, Mitch.
Is that Hillary?
It is.
Blast from the past. How are you, girl?
I'm doing great. Thanks. How
Good.
are you?
Good. It's good to have you on the call. I'm glad you're here.
Yeah. It's a goal to get back into this. So I'm
Good.
excited about this year. So I got
Well,
married.
we're here every week, Tuesday, 6 p.m. Mountain Time. So it's the
Perfect.
same link every
link,
week. So
or-
make sure that you're there.
Perfect.
You'll be getting the text messages as well.
Yeah, I didn't know. I just got one today. So perfect. So my husband, and
Congratulations.
I are, thanks. We're wanting to purchase the house that his ex-wife's living in. However, so what we want to do is just refinance because his name's still on the title. So it kind of needs to go through like a judge and stuff. I actually just wanted to know if we can email you about all the details and then discuss it a little bit further.
Absolutely.
I don't know all the details, but it should be pretty good. She, as far as I know, she just wants like 30 to 50,000 out of the deal and then move on. And then we should be able, I think we're gonna hold it for a bit and rent it out, fix it up a bit. And in that area, I think we can refinance for 250, 280, and then resell for like 350, something like that.
Where's the house at?
It's in Orem.
Orem,
It's
Utah? Okay.
yeah, it's close to State and Parkway, University Parkway, but so right in the middle, kind of heart of Orem.
Yeah.
And just a little rambler, top and bottom. So yeah.
Is
So
it
I'm not-
is so you said 30-ish thousand is what the ex-wife is looking for. Is that
Yeah.
because there's $60,000 in equity? Is that where that number comes from?
That is a good question. So again, like he knows a little bit more of the details than I do.
Okay.
So it'd be nice to talk with you a little bit more about it. And
Absolutely. I'd be happy to discuss.
yeah.
Absolutely. So I'm just doing some quick math just because, I know there's a lot of things that you don't know that, your husband.
Yeah, exactly.
But let's talk about the kind of the general principles of this area of what we're working in. So divorce situation,
Yeah.
husband and wife are both on, or ex-husband, ex-wife are both still on title.
Yeah.
She wants off, he wants the property. So just going off the assumption that there's $60,000 in equity, she wants half of that, 30,000. So if we have $210,000 refinance on $240,000, we're at 87.5%. So on a cash out refinance, that might work with some banks. Most banks are going to want to see somewhere between 10 and 25% on a rental property, right? And most right now, because of the uncertainty with a presidential administration change, with the pandemic going on, there's a lot of uncertainty in the real estate market when it comes to traditional financing. So you're going to find that most banks right now are going to be leaning towards that 25% equity, especially on a cash out refinance. Now, if you're doing rate and term, it might be a little more flexible. Rate and term means you're not taking any cash out. You're just refinancing the debt to get a better rate or to get a better payment, right?
Yeah.
And you're kind of resetting that 30-year clock. One thing you might want to look at is, I know that there are certain local credit unions, and Hillary, since you still live here in Utah, yes?
Yeah. In
Okay.
Orem, yeah.
So you might want to look at, I know Mountain America is not one of them. Mountain America used to be one I recommended all the time. And then they changed their rules. But either a home equity line of credit or a collateralized business line of credit. That way you're able to refinance out the debt, and you can get like a
Bluetooth connection is.
Oh, I heard a Bluetooth thing going off. You can get like a 90% loan to value, right? So you're going to have about 2.5 to 3%, not a whole lot. We're talking, $2-3 grand of availability in that line, but that's going to give you some wiggle room, some emergency fund if anything were to happen to this property. But it's also going to allow you to use the speed banking or velocity banking principle, because now you have a line of credit, right? You have a $200,000 line of credit, or $210,000 line of credit, $215,000 line of credit that you can work off of. Granted, most of that's going to be maxed out, but it gives you the vehicle to start doing those things, and you can pay off that mortgage faster. So then you've got debt-free real estate. You can also use it as an operating account to pay your bills. As you start to build up some equity, you can go out and start acquiring some other properties. There's a lot of really good things. So that might be a direction, Hillary, that you want to look, is at a potential line of credit versus a 30-year mortgage.
Yeah. I know there's a lot to think about, a lot of different strategies that probably could be done, but I'm just relearning a lot, I feel. And
Love it.
So
diving back into it, right? That's the nice thing about lifetime access education, though, is it's still there. You can still dive in and relearn this stuff.
super grateful for it.
Absolutely. We gotta, life happens, right? We all take a break sometimes. I feel like I just kind of took a huge detour in 2020, and now 2021, I'm re-energized and I'm back, and here we go. Right. So it happens, but we're happy to have you back, and hopefully I'll see you on a weekly basis on this call.
Thank you.
Yep, absolutely. All right. Thank you, Hillary. So we've got, did you have more to that question?
How can you just shoot me your email, text, or I'm not sure. You have the
put it in
same
the chat right now.
Sounds good. Thanks a lot.
Yep, you got it. It's just Mitch at mitchanelson.com. Easy to remember, but it's in the chat as well.
Perfect. Thanks.
Absolutely. Okay, good question from Hillary. Hopefully there was some good stuff to learn there. Now, divorce situations, just a couple of things on that, because every divorce is different. Both my wife and I have gone through divorces in the past, and we had very different experiences in our divorces. My divorce was a little more ugly, and it resulted in losing some real estate and losing some money, and however, my wife's divorce was very amicable, and they're still friends, and we see her ex-husband on a regular basis, and so that just exemplifies that there's a spectrum of how divorces can go. And so when you're dealing with a property that's locked up in a divorce situation, you don't know what you're going to be dealing with. You don't know whether these people are going to be cooperating, or whether they're just going to be, they don't care if they die in the process, they're going to take down their ex, right? And so, you know, I was at that lunch I mentioned earlier today, a situation came up where a guy was trying to unload a house for like a $250,000 discount just to spite his wife, just to spite his ex-wife. He was going to take a loss on the house just so his ex-wife wouldn't get any money, right? And I'm thinking, geez, if that were me, I'd let her have money. I want money, right? So let her have some of the money. I want to make money on this deal. But you find situations like that all the time. You know, these divorce situations, we've got to be flexible. We've got to have the ability to, once we've assessed the situation, to be able to work with whatever party we're going to be working with, or be able to work with both parties. It can be difficult in a situation where the exes aren't speaking to each other. It can be really difficult because now you're playing middleman. Well, he said this, and well, she said that, and you know, they said if you were willing to do this, then they'd be willing to do it, or you want to do it. And well, if she said that, then no, I'm not willing to. You know, all sorts of stuff you're going to have to deal with. A lot of times, it isn't worth the time to go after a house that, you know, they're fighting and they're not going to be able to come to an agreement on something. Sometimes it is. You just kind of have to play it out until you make the decision, hey, this isn't worth my time anymore. I'm moving on to the next one. In a lot of the cases with, you know, the amicable separations, it's a much easier process, right? They're willing to be in the same room together. They can negotiate with you at the same time. And it's a very simple, straightforward process. However, I find you're not always able to get deals at as steep of discount as you do when they're just trying to spite each other. So pros and cons to that, you know, but however, divorce situations are a great way to find deals. And it comes back to the whole idea that as real estate investors, we're problem solvers, right? If we can come in and solve someone's problem and create a win for somebody, we're going to find properties and we're going to find money. We find properties by bailing people out of bad situations. And in the case where someone's losing their house, we can prevent that foreclosure from going on their credit by buying the house from them or catching them up on their mortgage before the foreclosure happens. That's going to save 7 to 10 years of bad credit for that person. A win, right? And we get a win because we get the house at a discount. In a divorce situation, you know, you can split up stuff. He can take the TV and she can take the couch, right? But you can't split up a house. You can't cut it down the middle and give half to, you know, it doesn't work that way. So usually real estate is a source of contention in a divorce situation. If we can come in and be the problem solvers, and you have to approach it from that mental angle. If we can come in and be the problem solvers, we'll get the deals, we'll get the money, right? So creating wins for other people, that's huge. All right, let's move on. Any questions here? I'm just looking through the chat to see if there's any other questions that I haven't answered yet. Looks like Tyson got Kathy's question answered. Sheri's celebrating because she said, Mitch found me money for my deal. Awesome. Let's make sure we talk about that. Anybody else want to come off mute and talk about some of the stuff that they're dealing with in their real estate business today?
Hey, Mitch.
Hey, Aaron, what's going on, my man?
Nothing much. I got a question.
It's been a little while. How you been?
Yeah, it's been a long while since I took a break myself
Attaboy.
for this year or last year. So
good. I'm glad to have you back.
Yeah, I'm glad you sent me that text. So I'm glad to be here.
Yep.
So I was curious about where does a credit partner come in? How does I'm not sure how that works.
Do you have a situation where you're thinking you might need a credit partner, or are you just looking for some education on the idea of credit partners?
Just an education.
Yeah.
Well, and myself, you know, I've got great credit.
You could be a potential credit partner as well.
Yeah.
Okay, awesome. Well, I might have a situation for you where that might be useful and we could partner up.
Okay.
Now, normally so let's talk offline about that. Honestly, credit partners are incredible things, right? We talk about the 5 currencies: time, knowledge, relationships, credit, and money, right? You need partners in all those areas. You need people to fill those bank accounts, right? In time, knowledge, relationship, credit, money. Employees are a great way to save you time and leverage other people's time. Knowledge, obviously the smarter you are at something, the lower the risk, and the more likely we are to be successful in real estate. So knowledge is huge. Relationships, we talked about that today. That was the topic of today's training, right? But credit, I think that's a very undervalued idea when it comes to partnering. It doesn't have to be your own credit, right? These people that have these ideas that I'm going to go out and get mortgages and save up down payments, that's a very slow boat process to real estate. And it's not ever something that's going to create wealth for somebody. It's going to be a few extra $1,000 a month. But if you can only get up to 10 mortgages and you're averaging $400 in cash flow per door, you cap out at $4,000 a month. And that's just not my idea of retiring wealthy. So you're going to have other things, Social Security and 401ks and all this other stuff that you would have had to have done over the course of 40, 50 years. And a lot of people aren't doing those things. So how can we fix that? Well, we need to learn how to leverage other people's resources. And we talk a lot about using other people's money, right? We talk a lot about bringing in equity partners, and they bring $50,000 or $60,000 or $100,000 to the table, and they get a certain percentage of the deal. But credit is such an important thing. Now, for example, this 13 unit complex that I talked about, this conversion that I'm doing up in Ogden, it is a deal that I am bringing in a credit partner on, and the credit partner is going to carry the mortgage. They're going to qualify for the construction loan, and then that construction loan will eventually turn into a mortgage that we just pay a monthly payment on, and obviously our income on a $3 million to $3.4 million property is going to be a lot higher than our mortgage that has a basis of $2.1 million, right? So, so there is an opportunity there where I don't have to tie up my credit. The person who comes in as my credit partner, I give them anywhere from 10 to 33%, usually is the range that I give credit partners. So anywhere from 10% of the deal to 33.3% of the deal. So a tenth to a third. And they get to participate in the cash flow. They get to participate in all those awesome tax deductions that I talked about. In fact, it comes back to the acronym IDEAL, IDEAL. Buy and hold real estate is the ideal investment in that we get income in the form of cash flow. We get deductions. That's the D, right? Deductions. We talked about a lot of those that we're getting on that 13 unit complex. That applies to single family real estate. It applies to commercial real estate. A lot of deductions in real estate. Equity. So as we pay down the mortgage, as that mortgage balance lowers, our equity raises. So equity, just in the simple form of equity, is what we paid for the property or what we owe on the property over time. That's going to drop because we're paying our mortgage payment. That debt balance is going to drop. This section here between what we paid for it and now what we owe on it, that's our equity, right? So when we sell it, we get to recapture all of that. That just goes back in our pocket. So equity, my credit partners, they split 10% equity, 10% to 33% of the equity in the property when we sell it. Appreciation. Real estate appreciates, and it does so to the tune of 3 to 5% annually on average over the last 200 years. So that's as much data as we have, right? But real estate's been around as long as humans have been around. That appreciation, where we may buy this thing for $2.1 million in. If we hold it for 10 years, though, tomorrow it'll be worth $3 million as we fix it up. But 10 years from now, it might be worth $6 million. It might be worth $9 million. Right. So that difference between the $3 million that it was worth now and the $9 million that it's worth in 10 years, that's appreciation. That's $6 million. Well, my credit partners are going to get 10 to 33% based on the deal. Right. So income, deductions, equity, appreciation, and leverage. The beautiful thing about real estate is it's leverageable, right? We can take that property, we can take that equity we built up. And if we want to be partners long-term, let's go refinance out that equity and that appreciation. And let's use that cash to go buy 4 or 5 other properties. So now we're not one deal, us partnering on one deal turned into us partnering on a portfolio of 5, 6, 7, 10 deals. Right. So the best way, and especially if you're looking at this, Aaron, from a perspective of I want to be a credit partner, the best way to do that is to actually be a partner, to have equity in the real estate itself. Right. Not just a promissory note that, hey, I'll pay you X% or whatever, or an interest rate above, because that's only income. You're missing out on 4 other benefits of owning long-term real estate. So being a partner, being an actual partner with a joint venture agreement or an LLC, or being on title, being a partner, you get to take advantage of all 5. And make sure, Aaron, that as you're negotiating this, that you remember to negotiate in all 5 of those things. So remember the acronym IDEAL: income, deductions, equity, appreciation, and leverage, right? I get to play. Hey, look, if you're using my credit, I get to play on all 5 of those things. So whatever your plans are, whatever you're doing with it, I get to play on all 5, right?
Cool.
Is that helpful?
Yeah, that's great, actually.
Good.
Cool.
Any other questions around anything I missed?
About credit partner?
Yeah.
No, that's actually more than what I thought.
Cool. Good.
It was.
Good.
So,
Delivering the value.
that was great.
Good. I'm glad to hear it. It's good to hear from you, friend. You gonna be here
Yeah,
next
it's
week?
nice to see you. Oh yeah. Yeah.
Okay.
I didn't know these were happening until I got the text.
Good.
So,
Good. It's
cool.
on. It's on. It's this same link all year long.
Okay.
So just
Cool.
save the link in your phone, put it in your calendar, 6 p.m. Mountain Time on Tuesdays. We got students from across the country here. So we are
Nice.
cruising. All right. So great question from Aaron. Any other things that we want to talk about today? Any other topics or deals that you guys are working on, obstacles that you're hitting? Feel free to come off mute and let's talk about it. Hannah, you just came off mute. What's going on, my friend?
Yeah. I have know of a situation where they moved into a retirement facility and the house has been sitting close to a year. How do I approach that to, get in on
So let me get this straight. The previous owner just moved into a retirement facility. So it's a senior citizen.
Mm-hmm.
And the house has been sitting vacant. Are they still the owner on the house? Do you know?
I don't know. I don't know them personally. I know of them through a client of mine.
Okay.
It's a neighbor of hers, and she's very worried about who's going to get that house.
Right. Those neighbors got a lot. They're investor. One of the
yeah. Well, a lot of investors are coming in and changing the look of neighborhoods. You don't like that, but anyway, they are in a retirement facility. I'm assuming they still own it. I mean, we're talking about a home that's probably $1 million. Yeah, but we're talking Austin, so it's in the prime zip code. So it's
what city again?
Austin,
Texas.
Yeah.
$1 million. Tell me square footage. What?
I don't know the square footage. I know it's a 3-bedroom, 2 half bath. Basically all it needs is just updated.
Starting to sound like Salt Lake City. That's crazy.
Yeah. It is. It's a prime zip code here, so the value is. It's an older home, but these are custom built homes.
Wade and I just jumped in on a deal today that we were on the phone yesterday. Was it yesterday or today, Wade? I think it was yesterday. We were on the phone, and we were just talking. This 3,700 square foot home that has an ARV of $1 million, and we're just like, what is happening right now, right? But it's all location. It's in a prime, like you said, Hannah. It's in a prime zip code, so we can ask $1 million for this thing. Had you moved this house 2 miles west, it would be worth $400,000. But because of the exact location it's in, it's worth $1 million, right? So,
right. It's the land the house is setting on that's worth a lot.
Location, right?
Yeah.
It totally affects.
But I mean, how do I talk to them about it or whatever?
Yeah.
I don't know how to approach it.
There's a couple of avenues. I'm going to start with the best one. And the best one, I'm going to call back to our training today. It's your relationship. You have a relationship with a neighbor who has a relationship that you can leverage. And this is a currency, right? You can leverage your relationship. The best way to get in front of the homeowner there, or in front of the homeowner's kids, because that's probably who you're going to end up dealing with if they're in a retirement home, is through your client, because there's already an existing relationship. Now, do you know the nature of your client's relationship with the homeowner? Do you know, is it a good
Oh,
relationship?
they're good friends. I mean, they talk on the
Okay.
phone. So
Yeah.
yeah.
Perfect. That is your absolute
They've been
best.
neighbors for close to 40 years.
Yeah, there you go. That's a slam dunk. Absolute slam dunk right there. That's your best course of action. Now I'll go through the others just for educational purposes. So always the best route is what we just talked about, is relationships, right? If you can get somebody to connect you to somebody else who is going to be able to make the decision on what you want to have happen, that's the best way to do it. Now, next to that, we can jump into RealFlow or PropStream or some of these other softwares that connect to tax records. We can even go down to the county and pull tax records ourselves and look at who the homeowner is and try to contact them. But a warm introduction is 100% of the time better than a cold contact, right? If you're just reaching out to this lady, hey, I know someone but anyway, can I buy your house? Right? She's like, who are you? Right? So it's a much more difficult process to do that than just getting a warm, solid testimonial from your friend saying, hey, Hannah is the real deal. She's awesome. She's going to come in and preserve this home that you raised your children in. She's going to, she's going to do an amazing job. She's not going to change the neighborhood. All the things that are important to that person, she's going to be able to share because she knows that person. She knows what's going to be important to that person. And then you're coming in and this lady's already thinking, well, hey, Hannah's the real deal. Hannah's who I got to go with. So all you have to do is not prove your friend wrong. Right.
Mm-hmm.
So that's it. So there's your avenue. I think that's what you need to explore is now, do you have a relationship with your client to where you can ask her for that?
Oh yeah. She calls me her daughter.
Awesome.
So yeah.
Okay.
Yeah.
Good.
And I have another question.
Yeah.
This client owns a condo in Mexico. It would belong to her sister who has already passed, and she needs to get her name on the deed. She hired a lawyer to go down to do it. He stayed in the condo and had a great vacation, but didn't get it done. How can I help her get that deed fixed?
Okay, you may need to run through this again. So
the condo was the deeds are in her sister's, who has passed away several years ago, and
but it's her condo.
She needs this deed, as she took ownership, but then the deed does not reflect her name, so she can't really do anything with this condo. How can I help her navigate through that? Because she's already been ripped off once.
Was there a will or a trust?
Trust. It was a trust.
There was a trust. Okay. Then she needs an attorney. It should be a fairly painless process. If there was a trust and the trust stated that your friend, it was your friend, right?
It's a client. Yeah, it's a client.
A client. Okay. So your client, her sister passed away. Her sister had a trust that said, in the event of my death, here's all my beneficiaries, and here's how my estate is granted to these beneficiaries. And your client happened to be the one that received the home as part of her as part of the trust, correct?
Mm-hmm. Yeah, that's my understanding of it. Yeah.
Okay, right. And this you're just.
It's just that the big thing is it's in Mexico. And so she sent down an American lawyer to Mexico. He didn't come back with a change, but he had a great vacation and she paid for it.
I'm sure he did. Yeah. Okay. Yeah. She needs an international attorney. She needs a different attorney.
Yeah.
Probably put a bad taste in her mouth with attorneys, but you know what? They're not all like that. So she's an international attorney though. And that's going to be a little
an international attorney. Okay.
But she needs
I can do that
practice
for
law
her.
in the US and in Mexico. And there are people there are plenty of people that can do that. So they're out there. She just got to find one. What state?
Okay.
Texas as well?
Yeah, she's in Texas. She's here in Austin.
Yeah, especially in border states like Texas, you should be able to find an international attorney, no problem. I would do an international estate planning attorney.
Okay.
And then because the deed, the granting of the deed happened in the trust, and that's provable because there's a trust document, right? So if everything she's telling you lines up with what actually is happening, there's a document that states that your client gets that house. So it really is just a matter of taking that document to the appropriate authorities in Mexico and saying, hey, we need to just make a change on this deed. This lady's passed away. Here's the death certificate. Here's the trust documents. We need to just transfer this to the appropriate person that's still alive. So, and that's it. So it should be fairly inexpensive. And honestly, it shouldn't warrant a trip to Mexico.
Really?
Why he
That's
went
good
down.
to know
It
too.
shouldn't warrant a trip.
Yeah.
We've got
No,
them
she
up,
paid
you
him
know.
a bunch of money. He
Oh,
flew down there. Then he came back and he said, oh, that the other party or whatever didn't show up.
cool. Yeah, it shouldn't warrant a.
She's a really
I don't
lovely,
think it
sweet
should.
lady. So yeah, I can,
Yeah, but tell her, hey, I'll go down to Mexico and try to talk to these people for her. She wants to pay
Yeah.
for it.
Well, I'll definitely help her get a good lawyer. That's what I'm thinking.
Yeah. No, absolutely. That's the key. Is just find a good international lawyer that you can trust. And I would raise a lot of questions if he says he needs to go down there, because email's a thing, right? I mean, you can email
Okay.
documents, right?
Okay.
We can email this stuff and they can get it resolved and email it back to us, and it costs us $200, right? For the
Ah,
so
yeah, she paid a lot more than that.
yeah, I'll bet if he took a whole vacation on her dime. Oh man, I bet the whole family was there too, right?
I don't know.
No, that is a good question. In international law, I tend to try not to invest overseas a ton. I've done it a little bit. I've got an Airbnb in Belize. It's been a nightmare. so
I
I
want to stay there.
I've just had to avoid international investing because it just tends to be a lot more of a headache than what it's worth.
But this was a family condo. They spent a lot of time in it. I mean,
Yeah.
a lot of time. But in the last, since her husband died, which was 20 years ago, it's just sitting there. She's not really doing anything with it, but
Yeah, absolutely. Okay, well, let me know. I mean, that would be where I would start if it were me working on that, so let me know if there's other questions or concerns that pop up, but that's where I'd start with it.
thank you.
Got it. Absolutely. All right, what else we got, guys?
Mitch, it's Rosa.
Hi, Rosa.
I have been hesitant to say this because Sheri's deal, this one's going to be tiny compared to her investment there on that property, but it's actually the opposite. I have the opportunity to be a lender, and the percentage that I would be the loan that I would give is collateralized by real estate, right? So there's collateral behind it to minimize my risk. But the interest that I'd be earning would be 10%. And I would get that 10% on month 1 for 6 months. The property
Say that last part one more time. It'd be what for 6 months?
It would be 10% interest annualized. So it's for 6 months. So it really ends up being like 20%. It's like $833 a month that I will be receiving on 50,000.
Okay, now just a clarification there before we move on, because I want to hear. So 10% annualized is 10% annualized. So if it's only a 6-month note, then it's actually your actual return's 5%.
Well, if I look at the breakdown, I took a look and I did it on a calculator. The promissory note shows it this way. It's
10% actual.
Month one, I would get 833. So if I look at it, I'm earning 833 times 6. And when I do the math, it comes out to, it's more like 20%.
20%.
How I see it.
Okay.
Does that make sense?
Yeah, absolutely.
Because if it's only 10%, it would only be 400 and change.
Right. Okay.
So I guess my question is this. I know the person. There's other opportunities that I have with them to do in the future not necessarily real estate transactions, but I want to make sure that I'm stepping into this opportunity to help and assist them with their startup. I'm in California, they're in Indiana, and the promissory note shows that if there is a breach, it would be under Indiana law. So I guess my question is, number one, if it is, if the collateral is backed up by real estate, and I'm earning, 10%, which is really equivalent to 20 over a 6-month period.
Right.
I guess 2 questions. Is it a good investment? And number 2, should I have it be under California law just in case it is breached? They have to come to me versus me having to go to them, or
Where's so they live in Indiana, you live in California, but where's the property?
the property's in Indiana, their business is in Indiana.
You're going to have a hard time getting a California judge to take that case if the property's in Indiana.
Okay.
What I always do as a rule of thumb is wherever the property is, right? So if they're in Indiana and you're in California and the property's in Arizona, I'd work under Arizona law. Because
So wherever the property is.
Wherever the property is. Yep.
So then my third question would be, should I do it where it's under my personal name? I'm loaning it personally to them, or should I form an LLC in Indiana and go that route?
You're creating a question where I have to give you the disclaimer answer, and that is I'm not your attorney. you gotta ask an attorney that question. However,
but you have been a lender.
I would never do a deal in my personal name, because then all of my entities are exposed if it's in my personal name, right? But if I do it in an entity, only that entity is responsible. So I would always do it in an entity. You need to consult an attorney if that didn't make any sense to you.
No, it makes 100% sense.
Right.
The reason, and I understand you're not an attorney, but I believe you have been in the position of a lender.
Sure. And my attorneys make me say that when you ask legal questions. So that's why that came out. It is, Rosa, it's A, I would do it absolutely in an entity. B, I would always use the state that the property's in for governing law, because then you get into conflicts, and what that ends up doing, if you say, hey, we're using California law here, but then the property's in Indiana, then they can raise issues and say, well, this happened and this was legal in Indiana, but it's not legal in California. And then the judge could say, well, then we have to throw out this case because we've got conflicting laws, or it draws it out to where your attorney's fees go way up. It's going to be cheaper for you to litigate in Indiana than if you try to litigate an Indiana property in California.
Got it. You as a lender, Mitch, what would you look for on the promissory note to make sure it's there? So I have, of course, solid interest in my opinion. I don't know what your opinion is there, but it's a property that there's no mortgage on it. There's no liens. I've researched that. And I know that what I want to have the deed of trust in the LLC's name. Is that how?
Yeah. So based on where they are in this process, will dictate my answer to that. So do they own the property yet?
Yes.
Or are they buying the property? Okay.
No, they own it.
They own it outright. Okay. So in any case, you're going to want to work through a title company. It's going to cost you a little money, but it is so worth it to make sure that all this is done correctly. They may even write the note for you. If you work with a title company that's actually done investment transactions of this type before, they probably have already pre-written documents that represent a note of this kind. They can handle the deed of trust. They can handle recording. They're a neutral third party, right? Because here's the thing: you've got this relationship with these business partners, and you give them the money, and you're like, hey, let me know when the deed's recorded, and they're like, okay, the deed's recorded, and then you're thinking, well, these are my new partners. I don't want to make them feel like I don't trust them by asking for proof. All these emotions start happening when you're dealing directly with the other party. If you got a neutral third party, you can be like, hey, title company, I need proof that this happened, and they don't care. They'll send you proof. That's fine. It's not affecting your guys' relationship. That's their job. right? So same reason we use property managers. So you're not dealing directly with your tenants, right? Because your tenants know that if you're the owner of a property, you've got the ability to forgive their rent, and you're just a jerk if you don't, right? But a management company doesn't have that flexibility. They don't own the property. Their job is simply collect the rent, right? And so they can throw the hammer down a little bit more than you can in that situation. Same case here. Use a neutral third party, use a title company to get all of that done, and make sure you have proof that the deed of trust is in place, that it's recorded on the title, and that's going to protect you from them ever going behind your back and selling the property or refinancing it or whatever the case might be.
Got it. Okay. Perfect. Thank you.
You got it. Absolutely. My pleasure. All right, we got a few minutes left here. We can take a couple more questions if you guys are interested. We can end the call. These calls, by the way, I know we've got a lot of people who haven't been on the call in a minute. So, the Ask Mitch Anything calls, they're every Tuesday, 6 p.m. Mountain Time. That's 5 p.m. Pacific, 6 p.m. Mountain, 7 p.m. Central, and 8 p.m. Eastern. We want you here every week. It's the same link every week. We usually go. The commitment is 60 to 90 minutes. So, if we've gone through all the content, there's no questions at the end of 60 minutes, we can wrap up the call then. If the questions and the content take all 90 minutes and go all the way to, half past the following hour, that's great too. I'm happy to share as much knowledge and information as you guys are willing to accept. So 60 to 90 minutes on these calls. We're about 10 minutes, 11 minutes past the hour here. So you guys get to control it. If there's more questions, let's keep going with this thing. So who's next? Who's got some stuff they're working on that they want to talk about?
Hey, Mitch, this is Dave.
Hey, Dave White.
Yeah, how you doing?
Hey, Dave. Good. How you doing, man?
Doing all right.
Good.
So yeah, I've got a question. I just bought a house out in Vernal.
Okay.
And so
Vernal, Utah, oil country.
Sorry, what?
I said Vernal, Utah, oil country.
Yeah, it is. I hope that the economy out there doesn't tank with anyway. But it's 1254 square feet, and it has a loft that isn't included in that. And it's an unfinished loft. So I want to somehow
unimproved lot.
Excuse me?
You mean unimproved lot, like it doesn't have power? Or?
Yeah, I didn't notice if it had power, but it just looks like there's no drywall, there's no flooring. There's just nothing there.
So the structure's unfinished.
Yeah, the loft part is.
The loft.
So so my question is, how do I go about getting that included in the square footage? I mean, I want to finish it and call it part of the house.
Oh, you're saying loft. L-O-F-T.
Yeah.
Okay, I thought you were saying lot. I thought you said there was a lot, like there's an extra piece of land that.
Oh no! Sorry about that.
That's where I was confused. I'm like, what do you mean? Okay, so the loft is unfinished.
Yeah. So it's just, yeah. So and it looks a little bit like that Almond Street loft you guys had. It's just it's got a lot of anyway. It's pitched but it looks like a great livable space. So how do I go about including that in like the square footage of the house? Like, do I just go to the zoning and tell them what I'm doing, or what? How does that work?
So at this point, is it finished?
No. I just barely bought it. It closed today.
Okay, perfect. Oh, congratulations. That's awesome. So you're going to have to, if you want that included in county records, that's Duchesne County, I believe, right?
I think it's Uinta.
Uinta County? Okay. So Uinta County, you're going to have to approach the county, pull permits. It may be Vernal City. It varies, city to county, whatever. It may be Vernal City that you're talking to. It may be Uinta County you're talking to. You are going to need to pull permits because the only way to change the legal records of what the square footage is to pull permits and have those permits closed out and receive your certificate of occupancy. So if that's going to be important to you selling your property for the ARV that you want, then permits is required on this project.
Okay.
Permits are required on this project.
Okay, great.
Now, one way that you could do it that I've done in the past, and it's not always the best way, because especially if you use agents tend to verify this kind of stuff a lot. You could, when you list the property, you could mention in the notes that have someone come out and measure it for, $50. You can get an engineer to come out and do a quick, they'll shoot their laser pointer at different corners of the house, and they'll measure the square footage for you. And then they'll give you a written document on their letterhead with their engineering firm saying, here's your square footage. So if you want to avoid pulling permits, that's the other way you could do it. Include that document in the listing. And there's an option when you go to list it, it'll ask, did you get this when it's under square footage? It'll ask, okay, where are you getting your square footage from? Is it a third-party measurement? Is it from the county records? What's it from, right? And you could say third-party measurement versus county records. Now, that does occasionally, for savvy realtors, they'll come back and they'll be like, well, why didn't you pull permits, right? Or why didn't you do this? Or why didn't you do that? You may want to have answers to those questions. If you decide to go that second route, you may want to have answers to those questions already prepared.
Yeah, I think I'm okay pulling permits in this case.
Then that's the best way to do it.
Okay, cool.
Good question.
Thanks.
Thanks, David. Hey, let's connect tomorrow, all right?
Yep, absolutely.
Okay. All right, my friend. Thank you. All righty. Good question. Permits is one of those things. It's tough because like I mentioned at the beginning of this call, working with the city is one of the toughest things you'll do, right? Working with the county and the city and all the hoops you have to jump through. It is one of the hardest parts, one of my least favorite parts of real estate investing. But, it's a necessary evil. In some cases, like in this case, where Dave wants to expand the square footage of the house that he's working on, it's going to be necessary to pull permits. There are some workarounds, but what I find is that I've kind of developed an attitude of do everything above board, right? Even then I still get stung and I still have lessons I have to learn, but by doing everything above board, by pulling the permits when you should be pulling permits, by staying in the radar, I guess, for lack of a better term, it's a lot less work. If you're going to do real estate at scale and you try to fly under the radar on everything, you're spinning so many plates that you're not going to be able to scale very big. Right. And then the money that you're saving by skirting under the radar really is creating opportunity costs for you to go out and expand your business beyond, what you have to. Now, to say that, there's been scenarios, especially early on in my career, there were plenty of houses that I didn't pull permits on that I should have. Right. And those were mistakes that I made and lessons that I learned. And you go on to the next one that much smarter, that much wiser. But Dave, I think you're smart to pull the permits on this one. I just think that's the right way to do it, not flying under the radar. And I think it's the least likely solution to bite me in the butt on the back end of this project.
Cool.
All righty. Anyone else want to come out? We've got about 10 minutes, 12 minutes left here. Anybody else want to come out and talk about anything that they're working on, that they've got questions on or want to share with the group? By the way, guys, it's not just my knowledge here. If you guys have experience in any of the things that your fellow students are asking about, feel free to come out and share your opinions, share your thoughts, share your experiences. So a huge part of this and a huge part of relationships is community. Right. And we're a national community here. We've got a lot of people with a lot of different experience to bring to the table. So feel free to come out and share your 2 cents if you've got anything you want to say.
Hey, Mitch, it's Rosa again.
Hi, Rosa.
Hi, I have a property in Orange County that we are rehabbing.
Okay.
And it is an existing rental. What is the best way for me to figure out when the general contractor gives me the quote on the different things we're going to do to make sure that I'm not being overcharged on certain on the project per se? So what is the best way?
best way is to get a minimum of 3 quotes.
Minimum of 3 quotes.
Yeah, and make sure you're comparing apples to apples. You know, if someone's going to be putting a 3rd story on the house, you know, you can't compare that to someone who's not going to be doing that, right? Because then it's not apples to apples. But yeah, get 3 quotes, and I usually let people know that I'm getting quotes, right? Get different bids, and that tends to make them a little bit more, you know, tighten their belt a little bit more on the estimate that they give me. But yeah, that's the safest way to do it, is get 3 bids.
And because there's of course the flipping business is so common, is there an easy way to find dedicated people that do the rehabs on fix and flips? I'm sure there's a team in every city, many businesses, right, that are simply doing rehabs, which I'm
Yes.
assuming that can get their hands on, you know, since they're doing volume, they probably have better pricing because they're able to get better pricing on their services.
This is a great question, and this leads back to the training today, right? Relationships. One of the best ways to build and find new relationships is networking. Are you a part of your local RIA, Real Estate Investor Association?
I am a part of one of the groups here locally, but they haven't really had any meetings physically.
Right now, right?
Yeah.
Yeah. You know, I have, so let me share with you my experience. And this is, I'm sure, unique to me. I mean, it may be something you can copy. It may not be something you can copy. I work, and I have worked the last 7 years of my career with a guy named Steve Clayton. He's been in all of our episodes so far. So check out Flippin' Sexy Real Estate on YouTube to watch our most recent episodes of our web series there. But he's a business partner. One of the things I did early on, and I started as a real estate investor in 2013, and in 2014, I set up my own construction company, not because I was going to hire a whole bunch of workers to go out and pay them hourly and buy trucks and all those things. I set up a construction company simply as a liability shield. What I realized very quickly within my first couple of deals is, if I'm paying contractors out of the same LLC that owns my property's at risk if one of these guys get hurt. So I created a separate company called Man Construction. My initials are Man, M-A-N, Mitch A. Nelson. I call it Man Construction. And Man Construction would get paid by the entity, my LLC that owns the real estate, would pay Man Construction, and Man Construction would pay the contractors. It was simply a way for me to protect myself from liability. Well, as I started to grow and scale, as I started to do 3, 4, 5, 7, 8 properties at a time, I realized that I needed a dedicated person to manage the construction side of it, because it was a full-time job for me just to manage the acquisition, the negotiation, the money raising, etc. So I brought on my partner, Steve, and gave him 50% of my company. Now, Rosa, this was after 4 years of working with Steve that I gave him 50% of my LLC. So allow there to be some time. And Steve was not the first person I tried this with, right? I tried probably 2 or 3 other people that ended up ripping me off to the tune of anywhere from $20,000 to $50,000 before I found Steve, who is someone who has been incredibly honest, has an incredible amount of integrity. You know, he's been on time, pretty close to on time, and pretty close to on budget in most cases. So, you know, you'll find your Steve, but it's going to require maybe getting some bumps and bruises along the way. And that's okay. Getting bumps and bruises is okay. You just need to, you need to get out there and form these relationships. So with that said, you may eventually find someone that you want to partner up with, someone who will run the entire construction management side of your flipping business. But for now, you just got to kind of start forming these relationships, go with the best person at the time. And, that relationship may eventually fail, or maybe it'll last forever. There's only one way to find out, right?
Thank you.
Yeah, you got it. Did that help?
Sounds like a marriage.
It's very much like a marriage. Yeah, absolutely. And
yes, that helps. Thank you, Mitch.
Yeah. And you know what? Steve comes with his drawbacks, just like I'm sure I do, right? Steve's kind of an a-hole. So I got to deal with that on a daily basis. But you know what? He gets the projects done. So it's a give and take, just like a marriage. That's a good call, Sheri. All right, Hillary Farra. just asked, I want to ask everyone's advice, just because I never have, on time of your day or a week do you spend on real estate, and what do you focus on to find your type or goal investments when you're beginning? Okay, so Hillary, your question is what types of property should you be going after? That's going to be very personal to everybody. First off, my first bit of advice is going to be focus on something you're going to enjoy doing. One of my early students, he's been a guest speaker on this call. Hillary, I'm sure you remember Dane. Dane's very successful now. Dane runs a very successful hard money business, and he got into that hard money business through a conversation that he and I had about 5 years ago. He had done a couple of flips. He came in strong, right? Dane was somebody that I actually met working at the Apple store before I ever got into real estate. I got into real estate in 2013. I met him when I was working in the Apple store part-time in 2011. And we just became friends. And then when I went off into real estate, he called me one day and said, "Hey, what are you doing?" I said, "Well, I'm semi-retired. I'm working real estate. I don't have a job." And he's like, "Well, I'm in, let's go." So he was one of my first students that I took under my wing. He's like, "I want to do what you're doing. I want to jump and do some fix and flips." And Hillary, I think I met you at one of the fix and flips that Dane and I did together at the Jordan Meadows in West Jordan. We did maybe 2 or 3 other flips that he did as I was kind of helping him through it. And by the end of his third flip, he came to me and he said, "I hate fix and flips. I hate them. I don't want to do them anymore. I don't like working with the contractors. I don't like the liability that's created. I don't like when it goes longer than what we planned on. I don't like when things don't go as expected." I said, "Okay, well, what do you like? Let's change this conversation. What parts of it did you like?" He said, "Well, I really enjoyed raising the money." I said, "Okay, well then let's just do that. If that's the part of real estate that you enjoy, let's just do that part of it, right? Let's raise the money." And here he is 5 years later making $100,000 a month on his hard money business. So you're going to find that thing. It may be totally different from what you think it is right now, right? But you will eventually find that thing, Hillary. So what it's going to take is make a decision now, knowing that decision is not.
Bluetooth disconnect.
What's that?
Oh, sorry.
Oh,
Go on.
okay. So make a decision now, knowing that, on what you think you're going to enjoy. And knowing that it's not going to be lifetime permanent, right? You're not marrying this type of real estate investing, right? It might be wholesaling, it might be fix and flips, it might be rentals, it might be Airbnbs, right? It can be whatever you want, whatever sounds fun. And then you get in and you do it and you realize, holy crap, I'm not having fun. And then we have another conversation. What did you like about it? What did you not like about it? Let's focus on the things you liked. What other things can we do that have those elements that you liked, that don't have the things that you didn't like? But a lot of that is going to be dispelled in the crucible of actually doing it, right? We're not going to melt away any of those impurities if we don't light the furnace, right? So you got to get out and you got to light that furnace. You guys just got to get some deals under your belt, and let's get a few of those done. So let me ask you, Hillary, what types of deals are you leaning towards right now? What do you want to do?
Like everything. It's hard to decide. I would love to do some Airbnbs, fix and flips. I mean, I think everybody kind of starts with that, fix and flips. And I definitely want to get into some bigger stuff eventually. Making bigger chunks of money. Yeah, like building condos and stuff. But
absolutely.
I mean, that's ideal and dreamy,
right? But we got to start with the small stuff.
Right.
Airbnb has a very, if you do it right, now there's wrong ways to do it for sure, but if you do it right, Airbnb has a very low bar to entry, meaning that you don't have to go buy a house. You can do an Airbnb on something you're leasing as long as it says that you can in the lease. So you don't own real estate yet. You can make Airbnb money on other people's real estate, right? That may be a great place to start. Now, also knowing that you have, costs of getting into furniture and, and staging and whatnot. You're going to have some costs there, but it's not going to be hundreds of thousands of dollars to go out and start an Airbnb. So
Yeah.
you can bring equity partners in on that stuff that will venture with you. So, it's, if you were to pick one, because you mentioned flips and rentals, or flips and Airbnb, which one of those two is more appealing?
I thought it'd be actually best to start with wholesaling just to get some collateral.
Yeah.
But yeah, I'm not sure. I think that or Airbnb. And really it's just I have a hard time focusing on like making time in my day for this. And so that's kind of the big question for me, like what people do in general.
I found a couple of things because I know I've gone through exactly what you're talking about personally in my life, right? And in relation to real estate investing. There was after I bought my education that I bought when I was first a newbie, there was a time for about a year that I didn't do anything. I didn't do a single thing. And my wife was like, hey, I spent $20,000 on my education. You spent 20 grand on this thing. When are you going to do something with it? Right. I'm like, oh, I'm just figuring out what I want to do and blah, blah, blah. And it took me some time to get into the right place in my life where I could actually execute on it. However, we do kind of have that analysis paralysis sometimes, right? There's so many options that we just kind of shut down and we don't know what to do. So I think the key is deciding, with Airbnb, it's, a lot of Airbnb is negotiating. It's negotiating with management companies. It's negotiating with whether that's the management company that you're leasing from or the management company that is managing your listings on Airbnb. It's a lot of design. That might be something that you're interested in. Design something you're interested in. Airbnb is a great niche for you, right? Wholesaling it's dealing. I mean, it's peddling, right? It's sales. You're negotiating on buying, you're negotiating on selling, and that's all you're doing. Buy, sell, buy, sell, buy, sell. So negotiating. If that's really kind of where what you're excited about, wholesaling is going to be a great thing. Fix and flips is a lot of management. You got to manage people, right? You got contractors you got to manage. You got agents you got to manage. You got all this stuff you got to manage. And so if management is your forte, fix and flips might be where you want to jump in and get started. However, I do think Airbnb and even more so wholesaling have very low bars to entry. It's very easy to get out and get started. There's fewer hurdles that you're going to face along the way to get a few deals under your belt. So I think those are great areas. But my biggest advice to you, Hillary, is make the decision. Pick one. Focus on one. And then when you get a few under your belt and you get bored with, hey, I know how to wholesale like a champ now, and it's not challenging me anymore, then start doing your Airbnbs. You don't have to limit yourself to one for life. Just pick one to start with.
Awesome.
So it's not life altering, right? So don't put that kind of pressure on yourself.
Yeah. Cool. Thank you, Mitch.
You got it. Absolutely. All righty, guys. We are half past the hour. We have hit our time. So guys, thank you so much for being a part of this meeting today. I'm going to try to have a guest speaker for us. I've been working back and forth with this individual for the last 2 months, trying to find a time that works for both of us to get him on the call. But he is absolutely an amazing personal coach and deals a lot with mindset. And that is a big part of real estate investing. So I'm going to try to get him here next week. If not, we'll find a time for him to get on. Thank you for being here. Make sure you save the link because we are here every week at the same time, same place. And I would love to see all your smiling faces here every week. Let's go out and tackle this stuff together, right? The stronger we are, it's relationships, right? We're much stronger together. And the more people we have on this call, the more resources we all have to pull from. It's about community. So thank you for being here. Go out and have an amazing week. If you need anything, I'm here. Most of you have my cell phone number or email address. Reach out to me if you have questions. Otherwise, I will plan on seeing you guys next week. Stay healthy, stay safe. I love you all, and we'll see you next Tuesday. Take care. Bye-bye.
Yes.